Hello, welcome. Everyone seems to be trickling in here. We're just going to wait 30 seconds to a minute here to get started. Well, people are coming in. Again, thank you, everyone. This was had a lot of questions come in for this webinar, so we're excited to host it. It's a little bit of a different format than we normally do, where we're talking on a particular topic. And so what we did was we kind of segmented the information into different sections. And what we're going to try to do is have kind of a discussion where we have some charts we'll pull up. Jamie will ask some questions. I'll try to kind of answer them on behalf of the team. And what we will do is, if we have time at the end, we'll kind of open up, open things up for you to type into the Q&A, other questions that you may have or follow-up questions. So hopefully people are now familiar enough with Zoom. The Q&A is at the bottom, so you'll click Q&A. And then you'll type in your question. You can check anonymous, or if you're okay having your name shown, that's fine. We prefer that to the chat box. It's just an easier format. And if anyone has any issues, you can always send a message to one of us through the chat box. I'll turn it over to Jamie for a few comments, and then we get started.
Yes, thanks, Josh. Jeff, if you can go ahead and bring up the disclaimer. We just want to make sure that whatever we say today is not construed as advice to, each of you as individuals, but rather, generic in nature. Of course, the lawyers today require us to have disclaimers on just about everything we do, so we're pretty used to it. But we did want to just bring this up real quick. All right, let's jump into the questions that we received from clients. And I'll say that we, just as Josh mentioned, we've curated the questions into several main topics. And if we don't get to your specific question, that's okay. It just means it was a question specific to you that we should answer offline in a one-on-one situation. There's also no such thing as a bad question. We just had to narrow them down to those questions that would have the most relevance to the general audience. And so to start, Josh, we have a lot of client questions surrounding cryptocurrencies, including Bitcoin, which is certainly the most recognizable of all the cryptocurrencies. Can you give us a brief explanation of what it is and how it works?
Yeah, I think the easiest way that we like to explain to clients how to think about cryptocurrency and Bitcoin is to think of it as the underlying technology, rather than just something that kind of moves around as the price has been so volatile recently. So basically, the underlying technology allows for a digital currency to be transferred from person to person, country to country, organization to organization, with very minimal cost, without a financial intermediary, and effectively instantaneously. And the way that it is able to do that is because it uses a decentralized ledger. And so, this gets very complex, but essentially, if I'm sending Bitcoin to Jamie, that transaction is public and transparent to everybody who owns Bitcoin. And there are very powerful computing systems that are solving algorithms, complex mathematical computations, in order to verify that, in fact, the Bitcoin that I'm sending to Jamie is legitimate. Once that transaction is processed, it becomes part of the blockchain. And so for someone to go in and kind of essentially edit or manipulate it, they'd have to solve or redo all the mathematical computations up to that point in the blockchain. So that's why it's pretty widely recognized that the blockchain itself is immutable. So that's the utility of the blockchain. what the technology is and what the price is, and we're going to kind of talk about, I think, next, are two very different things.
So it's been pretty volatile, not just this year, but over the past couple of years.
Correct.
Is this something that clients should think about investing in?
So, you know, as a registered investment advisor, we have to be very cautious in terms of what we recommend. We do think that the underlying technology is very interesting, and as a platform could certainly change the way that commerce is done in the future. But the underlying kind of utility and technology is very different, as I said, from the price. And the price of any asset can be subject to significant levels of speculation, which, you know, we think if you look at what's happened with Bitcoin recently, it certainly is a possibility. And the most recent example that comes to mind is 2 weeks ago, Elon Musk, CEO of Tesla, tweeted that they'll no longer be accepting Bitcoin as payment for Tesla vehicles, and Bitcoin within seconds, minutes, dropped 20%. So that's not something, in our opinion, that's trading anything close to fundamentals. And if you look back over the last 10 years, this is the chart that Jeff just pulled up, you can see what we call drawdown. So this is as if you essentially held Bitcoin. The purple shows what percentage the price of Bitcoin would have gone down over these various time periods. So you can see 1, 2, 3 periods of time where Bitcoin dropped over 80%, and in one instance 90%. So from an investment perspective, you know, our general kind of across the board advice is that we're not looking at this as something that we are investing in for clients because of the level of volatility and speculation.
I think you probably just mentioned the word speculation for your 4th or 5th time. So a follow-up question would be, do we have any responsibilities as fiduciaries?
Yes, we do. So as fiduciaries, we're held to a legal standard to do what we think is in the best interest of our clients. And, you know, just as we would never recommend clients go buy lottery tickets because there's a huge potential payoff, because there's a very, very high probability that the money that's spent is you know, essentially going to be gone. We think similarly here, because of the speculative nature of the cryptocurrency and just how many unknowns there are, you know, investing in something like this, we view as not being suitable as a fiduciary. That doesn't mean that there aren't situations where individual clients come to us and want to have some exposure to this. We're not going to say, you know, no uniformly. The question is, how do we size it appropriately in the portfolio to make sure we're not taking too much risk?
What are some of those ways which clients can invest? Can they invest directly or through a fund or a trust?
Yeah, so we've looked at a number of the ways that this can be done. If you want to own the cryptocurrency directly, a company recently just went public called Coinbase, which is the largest cryptocurrency exchange. And basically you have your own digital wallet with Coinbase, and you're able to then buy cryptocurrencies directly and own the cryptocurrency directly that way. There's other avenues for how to purchase cryptocurrency. You can do it through PayPal as an example. Square has a app called Cash App where you can also purchase cryptocurrency. And then the way a lot of institutions are purchasing cryptocurrency is through funds. The largest kind of fund manager of cryptocurrencies is a company some of you may have heard of, actually, called Grayscale, where Grayscale goes out and purchases the cryptocurrency, and you're buying the Grayscale fund, which owns that cryptocurrency or cryptocurrencies. Importantly, we're not saying you should go do this. We're merely answering the question of how would one do it.
Great answer. So all the talk in the news recently, other than about cryptocurrency, has been about inflation. There's obviously been a lot of both fiscal and monetary stimulus over the last 14 to 15 months. and that has many worried about higher levels of inflation. The question is inflation, is it transitory or is it structural in nature? And could you briefly explain the difference between the two?
Yeah, so the talk of inflation has been happening, really since the first COVID stimulus bill was passed, because of the amount of money that was being sent, essentially printed and sent out into the system. And what now economists are discussing is, okay, we earlier this month we saw inflation print month over month, it was up about 0.8 to 0.9%, and year over year was up about 4%. And the Fed stance is that this is transitory. Transitory meaning it's going to be short-lived. Okay, this is not something that structurally has changed the cost of the prices of goods over the long term. And so our position on this currently is that we tend to agree that it is transitory in nature. Certainly you have definite increase in demand for a number of things. Lumber is a good example of this, and Jeff can pull up a chart. We've heard from a lot of clients, and you're all aware. I mean, lumber has risen, hundreds and thousands of percent over the last year as people spend more and more money on housing. But what's interesting is that, so there's a huge demand, but the supply constraint is not due to a shortage of wood, it's due to the actual production of taking it from a tree into lumber. And that is the investment in, something like a sawmill plant. So, these manufacturers, they're not reinvesting money to create a new sawmill. They're just they're just putting it through what they have existing. And so that's creating a shortage of supply. And our perspective on that is there are some areas where that increase in supply is going to take longer. But in general, across the board, we believe that the supply side will shift to accommodate the demand, and which is going to make inflation more transitory. Having said that, one area that we are focusing on and paying a fair amount of attention to is semiconductor chips, because those do serve as the backbone for the digital economy. And there is a chip shortage. You're seeing automakers, cutting back on the amount of time, cutting back on their production forecast for cars as a result of chip shortages. And this is a much harder thing on the supply side to just fix. It's a very delicate global supply chain, and the economics and the conditions to make these semiconductor chips do not happen overnight. Requires billions of dollars of investment and a lot of time to get them up and running. So part of the infrastructure bill is going towards this, but again, that could be something that is more structural in nature, certainly years versus months in terms of where we're seeing increased costs for things related or things that have chips going into them.
So that brings us to a question from a client as to whether we're considering making any changes to the portfolio if the inflation is considered transitory, meaning just temporary.
Yeah, I mean, one of the areas of risks we see, and just in terms of returns, is cash, CDs, anything that has a fixed dollar investment, fixed rate investment, is going to face some significant headwinds. So you can think, right, bonds are the most common example of that, and holding cash is another example of that. Those, if we have any sort of inflation, we already are, those are going to lose value that much more quickly. And so it doesn't mean that we think we should abandon fixed income, but we've already made a number of changes within fixed income, primarily moving to things like floating rate loans and treasury inflation protected securities. So within fixed income, we've brought down the duration of the fixed income securities, meaning rather than going out 10, 20 years, we've shortened it, okay? Which means that those investments are less sensitive to increases in interest rates. And we've invested in things within fixed income where they either go up in value in the case of inflation protected securities as a result of CPI increasing, or in the case of floating rate bank loans, the actual income that clients, that shareholders receive increases as LIBOR increases. So both of those types of vehicles are much less interest rate sensitive and are going to hold their value, in our opinion, a lot better through this time period.
So furthering that question, if we think about the extremely low yields in the bond market, we're primarily talking about the treasury market, right? Treasury and short-term corporate. So what can be done to generate income other than dividend-paying stocks?
Right. So one of the things we talk about a lot with clients, we really do try to focus on this, is not just looking at their return in retirement coming from the income that their portfolio produces. You always want to look at the return of your portfolio in terms of the total return, which is a combination of the income that's generated and the appreciation. So to the question, if we're focusing just on income, one of the areas I just mentioned, floating rate bank loans are going to produce more income, a lot more income in a rising rate environment and preserve their value as opposed to a fixed, corporate or treasury note. So that's one area. Another thing where we've shifted a little bit from the kind of traditional fixed income into something that pays a higher income stream is the utility sector. We think utilities as a sector remain attractive. They're paying about a 3% yield, maybe a little less in aggregate. But where we find it interesting is that a lot of the infrastructure and ESG spend that's going to take place is going to require utilities to invest a lot of money in plant, property, equipment, and regulated utilities get a guaranteed rate of return by the regulators on that spend. And so we view a 3% dividend yield growing at 5 to 7%, as an attractive potential opportunity.
So let's switch from low yield to no yield, which would be gold and other commodities. Should they be part of a typical, portfolio asset allocation?
Yeah, I think 4J Wealth kind of falls into the Warren Buffett, Berkshire Hathaway camp with this. A lot of people over the years have asked Buffett about gold, specifically precious metals, specifically as a hedge against inflation. And if you look after 2008, 2009, which was before this, by far historically the biggest fiscal stimulus we had seen, interest rates hit rock bottom lows, and people said there was almost certainty in pundits and investors' mind. Thanks, Jeff. That we were going to see double-digit interest rates, we were going to see rampant inflation, and of course none of that happened. It doesn't mean that it won't happen this time, but it means that they were way off last time. And so a lot of people poured money into gold with the idea that the dollar wasn't going to be worth anything. And so if we look back at gold going back about 10 years, you can see that the price from late 2011 of almost 2,000 per ounce is actually a little bit higher than it was today. So the point here is over 10 years, gold has not appreciated in value. There was some recent appreciation, and this just shows you how hard it is to take a narrative of inflation's rising, let me buy gold, because you can see there in 2020, early 2020, when the COVID spend started to happen to keep the economy afloat, look how fast gold increased, right? By mid-2020, by the summer, when we were still in the throes of figuring out the virus, gold had actually peaked at about 2,000, and then since then has fallen off. It's rising again recently. But the point of why I bring that up is using precious metals, commodities, gold as a hedge against inflation. The prices of these things can move very, very quickly, and they respond very, very fast to the news of or the concern over inflation. So, having a small portion of one's portfolio in gold or in commodities, we certainly don't have an issue with it. We think it can make sense. But our preference, our preference is to own companies where the commodity or the price of commodities would be an output, and therefore a benefit, and therefore the company would be a beneficiary of rising commodity prices. A good example of that recently is energy. Energy has done very, very well recently as the price of oil went from essentially negative last year. I think futures went negative temporarily to now it's at around $65 a barrel for West. I think that's West Intermediate crude. So you can buy the commodity directly, but you're going to have a lot more volatility. Or you can buy companies where the commodity is part of their production or related to their production. So you get the indirect benefit of having a company that actually provides a service or good and happens to benefit when the price of that commodity goes up. That's where we feel a lot more comfortable.
Good answer. So the next question is there any type of account that guarantees a minimum percentage rate? And this is going to be the key part here, something to keep up with inflation. So certainly we know that's not going to be a CD or a fixed annuity. How about TIPS or I-bonds?
Yeah, so TIPS and I-bonds are similar. I-bonds, which you purchase directly, treasurydirect.gov. You essentially purchase the I-bond and then it pays a very low rate. I think it's 0% right now, but then you get whatever the inflation print is. So every 6 months, whatever the annualized inflation print is, so I think most recently it was 3.56% annualized. That's what they're going to pay out over the next 6 months. And then CPI will print again and it'll adjust. So if inflation goes up, you're essentially going to kind of lock in that return in a risk-free way. The problem with the I-bonds is you can only buy 10,000 in a calendar year. So if you're looking to do something like that to really hedge your portfolio, depending on the size of your portfolio, it may work, but for most retirees, it's not going to be enough. TIPS, Treasury inflation protected securities, are similar in what they're trying to do, but rather than the income stream increasing, the price of the security increases based on what CPI does. So those two, I would say, the most direct hedges against inflation that we're aware of that will aim to keep pace with inflation. And not I-bonds, but in the case of TIPS, something we've implemented across many of the portfolios.
So how about for the client that is just looking to manage their investments? Maybe they've achieved their desired total asset level, right? So how would you advise, maybe it's later in life, so they don't have to worry too much about inflation, but how would you advise that individual or that couple from shifting risk away from the investor to a third party, or maybe mitigating that risk and maintaining adequate income? Is there a way to do that?
So just to make sure that we're all clear on the question, I think what the person who asked the question is asking is, let's say I'm at a desired level of portfolio assets. I'm not really worried about continuing to grow my portfolio, but I do want to make sure that I'm not bearing all of the market risk of the volatility, and I want to make sure the money, I can generate, income off of that for as long as me or my spouse live. Is that your understanding of the question?
That's correct. Yes.
Okay. So I think one of the things I would say that we've talked a lot about over the years with all of you is to think of your portfolio. Okay. We'll address the question more directly, but I think conceptually this is important, is to come back to what we call the bucket approach, which is to not think of your entire portfolio as something that goes up and down, but to actually segment it out so that the portion of the portfolio that's invested in stocks, where your growth is going to come from in the long term, is actually on a longer term time horizon mentally for you than the stuff that's not in growth. So what we do to help people with this is say how much we figure out from the financial plan, how much are they going to need from the portfolio? okay, in a given year to spend. And whatever that number is, we then multiply that number by 7 or 10 with the idea that in the unlikely scenario that the market doesn't go anywhere for a prolonged period of time, even a decade, that the client is not forced into a position where they have to sell stocks at depressed levels along that way, that they have that money earmarked outside of stocks for that purpose. So that would be I think that's the first part of the question, is to have that framework of thinking, because a lot of times that can reduce the anxiety over, am I taking too much risk in the portfolio, right? If you have those 10 years of buffer, that's a pretty significant, that's a significant kind of hedge against the market risk. But to answer the question a little more directly, if we forget the bucket approach, a lot of people historically, if they're relying just on Social Security, is they'll take a portion of their portfolio and they will turn it over to an insurance company, right? So they'll turn it over to an insurance company and purchase what's called an immediate annuity. And an immediate annuity, the insurance company says, okay, thank you for the money. Here's a contract. We're going to pay you X dollars for the rest of your life, or for a certain number of years, or for the rest of you and your spouse's life. And while that can be an effective option, I think what we need to keep in mind right now, what we're focusing on, is, generally speaking, the internal rates of return on those immediate annuities is less than 2% per year. And so if we're concerned about inflation and rising rates, whether it's temporary or longer term, locking something in like that, all else equal, is probably not the best decision.
All right, let's shift topics. We had a number of questions regarding taxes. Of course, the question we always get is, how to minimize taxes, but then also, of course, required minimum distributions. Let's kind of jump to our first question, and it's, are charitable contributions still valuable on a non-itemized tax return versus an itemized tax return? And then other factors to be aware of when making contributions.
Yeah, so it's a really good question. I think the first thing we need to back up and make sure everyone understands is all individual taxpayers get to choose between the higher of their itemized deductions and the standard deduction. Okay, so for married couples right now, the standard deduction, Jamie, Jeff, correct me if this is wrong, but it's roughly $24,000 to $25,000. So if your itemized deductions, which would include your mortgage interest, your property taxes, your charitable contributions, do not exceed that standard deduction level, then you're going to take the standard deduction. And so the question is, well, if I'm giving to charity, but I'm taking in the standard deduction, I'm not getting any additional tax benefit from it. So what's the point? So I would say there's two things to think about here. One is, if you are 70.5 or older, and you want to give to charity, the easiest and best way to do it, in our opinion, is through what's called a qualified charitable distribution, which is where the money goes directly from the IRA to the charity of your choosing. And that money is not going to be taxed. So it's essentially going to leave the IRA, go to the charity, and you will not pay income taxes on it. Typically, any money that comes out of an IRA will be taxed. So that's number one. Number two is, I think it's important, and what we've been talking with a lot of clients about, is to look at your charitable contributions over a certain period of time rather than just at 1 year increments. And there's something called a donor advised fund, or DAF for short, which allows you to separate the timing of the tax deduction and when the distributions are actually made to the charity of your choosing. So in the example of a couple who wants to give to charity but is under the standard deduction amount for their itemized deductions, what they could do is, rather than give the $3,000 or $4,000 to charity each year, they could bundle 3 to 4 or 5 years worth of charitable deductions and put it into a donor advised fund. They get the tax deduction for that full amount that year, which, when you combine with their other itemized deductions, could very well be greater than the standard deduction in that year. So they get to take a higher deduction. That money can be sent to the charities over a period of time, right? It could be all sent next year or over multiple years. And they still get the benefit, right, in years 2, 3, 4, 5 of taking that standard deduction. But by bundling the charitable contributions into 1 year and through a donor advised fund, they at least get the benefit of taking the itemized deductions in that year.
So that's interesting. So let's say they put in $100,000, right? And they plan to make the donations over the next 10 years. That's a long period of time to have that money just sitting there.
Right.
Are they able to invest inside of the donor advised fund?
Yeah, that's a great question. Yes, you are. You're allowed to invest. You can invest in 100% stocks. You can invest in bonds. You can invest in a balanced portfolio that comprises both. But the nice thing about the donor advised fund is that those gains appreciate tax deferred, and as long as they go to a charity, they'll come out tax free. And so you get a tax deduction going in, it grows tax deferred and comes out tax free. So in some ways, it's better for the charities long term as well. To your point, Jamie, because if the money grows over those 10 years, more ends up going to the charity.
That's great. Let's see. When it comes time to take required minimum distributions, which currently is age 72, that did go up with the Secure Act, right, at the end of 2019. But you don't really need the funds to cover your expenses. What are the recommended ways or places to invest after tax distribution?
Yeah, this is a very common question that we get at 4J. A lot of clients are in the fortunate position where they don't need the money from their IRA to live, right, for spending purposes. So remember, when you reach age 72, it's no longer 70 and a half. 72 is now the magic age for required minimum distributions. But when you reach age 72, and we'll go through this calculation, but a certain amount of money has to leave the IRA, and all the IRS cares is that it leaves the IRA so that they can collect their tax revenue. Beyond that, you could either park the money in your checking account, you could spend it all on a trip or a new car, or if you want to reinvest it, you can just open, if you don't already have one, what's called a taxable account, a taxable brokerage account, which is essentially just an investment account that's not retirement. And you can own the same exact investments that you had in your IRA. We do this all the time. If someone has a diversified portfolio and they say, I don't need this money, I want to reinvest it. Yes, there has to be tax withheld or tax paid on it, but we can transfer the positions in kind from their IRA to their taxable account. And so the growth of those investments can stay intact.
So in that case, you wouldn't even lose any potential appreciation or depreciation during the time period of transferring it from one account to the other.
Correct. It wouldn't have to go to cash even. Yes.
Okay. So we had a question. Do you believe it's a good idea to withdraw from your company's retirement plan or IRAs in the near term, let's say over the next 2 to 3 years, even if below age 72, since there's some expectation that income tax rates will increase over the long term, right? We know that the current tax rates are going to sunset at the end of 2025.
Right.
Could this be a good time to convert to a Roth IRA if you're in that what we call the gap years, right? Between the last year you work and the first year you take Social Security or have to take your required minimum distribution?
Yeah, it's a really good question. So again, just to make sure everyone's on the same page, what the question is asking is even though I don't have to take money from my 401k or TSP account until I reach 72, because my income, I'm retired now, my income is lower, my taxable income is lower, should I accelerate? Should I intentionally pull from those accounts and pay taxes on it with the idea that I'll pay less taxes now at current rates than I will later on? Is that Is that your understanding?
Yeah,
Okay.
that's the question.
Okay, so what our general advice is, and this does depend person to person because everyone's tax situation and financial asset positioning is different, which drives the answer to this question. But generally speaking, what we would advise people to do in that situation is rather than take the distributions as income for spending, is to what Jamie said is look at converting the money directly from the IRA to the Roth. You will pay taxes, right, on the conversion amount, but rather than just spending it by getting into the Roth, then the future growth is tax free. The kind of caveat to that is you have to have money in taxable accounts, right, whether cash or non-retirement investment accounts to meet your spending. So if you don't have that, then it could make sense to accelerate that spending, the distributions from those accounts for spending. But the better scenario would actually be to convert, if you can, to a Roth.
So this would kind of be a good combination with the question above, right? So in that case, the individual doesn't need the funds to cover expenses. They may be worried about taxes going higher, and they could potentially do a Roth conversion for the money to now grow tax-free as opposed to just having it go into a taxable brokerage account.
Yep, that would be if the person who asked the question above should certainly be looking at Roth conversions if they have not retired yet, or if they've retired or will retire soon. That would be a big opportunity.
Good. Is there a rule of thumb regarding minimum distribution from an IRA at age 72? And I think, Jeff, this would be a good time to pull up the IRS uniform lifetime table. So Josh can kind of go over how the calculation works.
Yeah, it's a question we get all the time. It's a very good question. And, we obviously will do this calculation for you if you're managing your accounts, but just so you understand what's happening. Let's just take an RMD that would need to be taken for this year. What the first thing we'll do is we'll look at what the December 31st balance was of your IRA account from last year. So that would be December 31st, 2020. And let's say that balance was $100,000 for this example. Then what we look at is what is going to be your age based on this uniform lifetime table as of the end of the year. And if you're going to be 72 as of the end of the year, you go across to what that life expectancy factor is. So that would be 25.6. You take the last year's year-end balance, divide it by 25.6. In this case, that's going to equal $3,906.25. That is your required minimum distribution, or your RMD, for 2021. It doesn't matter whether you take it in January, whether you take it in December, or you take it equal amounts throughout the year. They don't care how you take it out. They just care that it comes out of the IRA so that you have to pay taxes on it. And you can see as you get older, right, at 73, the life expectancy factor goes to 24.7, then 23.8. So when you divide by a smaller number, the percentage that you have to take out goes up. Okay, so they're essentially forcing you to take out a greater and greater percentage of your IRA as you get older, with the idea of you need to pay us tax money. It's time to pay the IRS tax money.
And what's the penalty, Josh, if they fail to take out the correct amount?
Yeah, so let's say someone just misses it. If we go to this example here of an RMD amount of $3,906, and they just forget to take the money out, okay? What the IRS will do is they'll impose taxes on the RMD amount, so $3,906.25, and in addition, they will impose a 50% penalty on that. So, an additional almost $2,000, $1,900 that they would impose as a penalty on top of the taxes you would owe. So definitely something you want to avoid. And by the way, just to make sure people understand, you can always take more than this amount. You're not penalized for taking more than this amount. This is just the minimum amount the IRS require you to take out so that you pay them taxes and avoid the penalty.
So let's go back up, and there was a question on, or a question where you then talked about a QCD, a qualified charitable distribution. We have clients that have a Fidelity IRA, and their question is, can they use checks from the Fidelity IRA to make the QCD, or qualified charitable distribution? In other words, can they write a check directly from their IRA to the charity?
Yes, it's an easy one.
Good short answer.
Yeah.
All right, let's switch over to the always popular topic of estate planning. And we had several questions on the level at which an estate becomes taxable. So what level of an estate do inheritance taxes become significant? I guess that term is relevant, right? But
yeah. So obviously, as Jamie said, this is a moving target. So we'll talk about what it is right now, but there's discussion and bills being proposed in Congress right now that would significantly lower this amount. And so it's something we're keeping an eye on. But I think, again, I'm a framework guy, like understanding the right framework to think about it will help then when you read about the information to understand it. So think of it this way. The estate tax only comes into play if you're married, so a married couple. The estate tax only comes into play at the passing of the surviving spouse. So if I were to pass away, anything in my estate is going to transfer over to my wife, and there's no inheritance or estate tax that's imposed on that money, right? From one spouse to another, no estate tax. If my wife then passes away, imagine an imaginary line between one generation and the next generation. That is where the government comes in and says, if your estate is above a certain level, there's going to be tax that you have to pay. And that tax will be at the federal level, but also states can have a state death tax as well, where you'd have to pay it at the state level too. So the question is, what are those levels? So right now, per person, it's roughly 11.7 million. So an example that I gave, as a couple, if the total estate was 23.4 million, right? Then when that second spouse passed, essentially the exemption amount would exactly equal the estate, and they would pay no estate taxes. Above that level, the current estate tax levy is 40%. Okay, so 40 cents on every dollar above that level goes to Uncle Sam. It is, if Congress does nothing, that exemption amount will drop to 5.8 million per person. Okay, 5.8 million per person, or I think that's 11.6 million per couple on January 1st, 2026. Our guess is this is going to happen sooner, whether it's cut in half or there's been talk about it going lower than that to 3.5 million per person or 7 million per couple. So what level of my estate do inheritance tax become significant? The answer is it depends. Right now, 23 million, but if the bill changed, if the law changes, it could be much less than that, where it becomes significant.
So I'll kind of follow up with my own question would be, let's say if someone passes away and they have 8 million, right?
Yep.
And half of that is from a house that they purchased, 30, 40 years ago, and the other half from a stock that they've owned for a long, long period of time. Okay.
Mm-hmm.
What is the value going to be to the beneficiaries? Are they going to inherit the cost basis of the parent?
Yeah. So the way it works right now is that there's a full step up in basis. What a step up in basis means is when the kid inherits, when the children inherit that property, the house and the stock, in Jamie's example, is their cost basis from a tax perspective will equal the value of those assets as of the date of death of the individual who passed away. Okay. Another part of the estate planning legislation that's being discussed is either eliminating or reducing that step up in basis that's allowed. And so if it were disallowed, that would affect many, many more people, because now it doesn't matter necessarily the size of your estate, but if you have something in your family that's been around for many, many years, and there's no step up in basis that's allowed, now in that the children inherit that property, if they were to go and sell that, right, the basis would be whatever the basis was from the parent or grandparent who initially purchased it. And so there would be a much bigger tax consequence. And in fact, I misspoke a little bit. I believe the legislation is talking about when the person dies, that embedded gain that they have would be taxable at their passing versus when the person, when the beneficiary sold it. So let's hope that doesn't happen.
Yeah, can you only imagine the nightmare of having to calculate what basis is on, a home that was purchased 40 or 50 years ago, or stocks for that example. So from the same client, he had a question: should he start giving to his kids now?
Yeah. So basically, for people, we always look at the plan for this. The answer is it depends. But if your financial situation is such where you running out of money is not really a concern, and going through the plan with us, we basically say, look, you're going to have more than enough money, probably going to leave a significant amount left over. A lot of people want to discuss how to give money to their loved ones, to kids and family members. So the basic thing to keep in mind with gifting is each person can gift $15,000 per year per person. So I can give $15,000 to Jamie. I can give $15,000 to Jeff. And there's no gift tax or estate tax consequences of doing so. My wife could give $15,000 to each of them as well. So when you think about giving money, you always want to think about in terms of $15,000 increments per donor, per beneficiary. So if I have a kid who's married and they want money for a house, between my wife and I, we could give them $60,000, right? 15 from each of us to one kid and 15 to the in-law, and that could be used for the house. If you give more than that amount in any given year, it doesn't necessarily mean that there's going to be a tax consequence, but it does need to be recorded on a gift tax return to show you gave more than this amount, and you have a lifetime exemption, which is equal to your estate tax exemption. So currently it's at 11.7 million per person. So you could give away a lot of money in your lifetime, not actually pay any gift taxes.
Right, here's a question with a little bit of a twist. Client has a primary residence worth, let's say, $1 million. They want to pass it to a son or daughter, have the son or daughter be able to live in it, and then later have it go to a charity of their choice.
Mm-hmm.
How can that be done, or can that be done?
Yeah, so you would want to. We've worked with clients helping them to do this before, things like this. You would want to work with an estate planning attorney, and what they would do is they would draft a trust, which would have you listed as the grantor. It would have a trustee listed and then beneficiaries listed. And the terms of the trust would essentially say at your passing, your child can live in the house as a life estate until a certain period of time of their entire life. And then when they pass away, then the house would be sold by the trustee at that time. And it could either go directly to the charity, or it could go into something like a donor advised fund, which could then be managed and grown over time. And the trustee could then decide over many years, here's how much I want to go out to a particular charity, at that time.
That's a really complex but potentially valuable tool that they could use.
Yeah.
Let's move on now to insurance. We had several questions on Medicare and long-term care.
Yep.
This first question came from a client, which this is interesting because it's something that we've been looking for a long time. But it's as I approach 65 and I've just received a Medicare card, I need to decide which route to go with my health health coverage. I'm not sure how best to decide and would appreciate your opinions on the best way to proceed. Do you have a licensed Medicare broker that you can recommend? And the answer is yes, yes, we do. And she'll actually be our next presenter for our June webinar on June 22nd. And her name is Margot Steinlage with Steinlage Agency. I don't know, Josh, if you want to add anything to that.
No, so we've looked at several of these types of professionals in the past, but we've never really felt comfortable with a go-to person. And we've been working really hard, I think, over the last couple of years of expanding our network, whether it's someone who specializes in long-term care facilities or Medicare brokerage, health insurance, or like Dana Hudson, the person who specializes in helping families when there's a cancer diagnosis. So Margot was a former attorney. This is all she does. And we understand, obviously, there's Medicare's Part A and B, and then you can either get a supplemental policy or a Medicare Advantage plan. But she walks you through the difference in coverages, the costs. It's very impressive. She has webinars on her site, but she's going to do the webinar for us in June for clients because there's so many questions on this, and she's wonderful to work with. So we will follow up in an email with her information, her name and contact information for everyone so that they have it.
Then can you explain what the lifetime benefit in a long-term care policy refers to?
Right, okay, so if you have a long-term care insurance policy, there's gonna be a couple different components to it. One thing you're gonna have is either a daily benefit or a monthly benefit amount, okay, at the start of the policy. And then you're gonna have a benefit period, which is the number of months or years, okay, that monthly or daily benefit is going to last. If you were to multiply the monthly benefit amount by the number of months that the policy has coverage, that would give you the lifetime benefit amount, okay? And that lifetime benefit amount is always going to be a function of the benefit period and the monthly benefit amount. And a good long-term care policy will have a cost of living rider on it. And so that cost of living rider is going to increase that monthly amount every year by whatever that inflation rider is, which would have a one-for-one increase on a direct increase on the lifetime benefit as well.
Good answer. Our next question is on, does 4J plan on a seminar on how to evaluate financial data to determine a suitable retirement community? Simple acronyms tend to fog up the view, whether it's continuing care retirement communities, CCRC, or Committee on Rehab Facilities, CRAF. It can be confusing, and we think it requires working with someone who solely focuses in this area. Just like the Medicare consulting Josh talked about above, requires a specialist. We do have someone we can refer you to, and we referred clients to her before, which is Peggy Brita. She owns a company called A Family Tie, and it's just simply afamilytie.com. If you go look on her webpage, she'll talk a lot about the different types of communities and continuing care that's available. I think, Josh, we should probably also send out her information and a link to the website so people can contact her directly.
Yeah, we can send out her and Margot's information. And Jamie and Jeff, I know, have done a lot of detailed financial analysis for communities like Green Spring and Goodwin House. They have various structures on, if you pay this amount monthly and you pay this down payment, and here's how, here's what you might get back or not get back at the end of life. So all these things have different structures. We can certainly analyze all the financial component of it, where someone like Peggy is really helpful, is understanding your needs and what you want and which type of community is going to be the best fit for what you're looking for.
Right, and now we're to our final prepared question, which is, and this is actually probably one of the most important questions, even though it's relatively simple, is can you explain how compound interest works?
Yeah, so there's a chart I think that makes sense to look at, but the easiest way to think about compound interest is the interest you earn on interest you've already made. And interest is not a broad enough term. It really should be the return that you make on the return that you made the previous year. So if I invested $10 and it earned 10%, now it's $11. Now, if that $11 earns 10% the next year, I don't make another dollar, I make $1.10. That is, so over a couple of years, it's like, oh, big deal, compound interest, what does it mean? But when you expand your time horizon 15, 20, 30 plus years, compound interest, I think Albert Einstein called it the eighth wonder of the world because of how incredible the effect is, right? People think in linear terms, but compound interest is actually an exponential function. So easy example would be if you invested $1,000 into an S&P 500 index fund back in 1969, so about 50 years ago, it would now be worth $41,273 if you just kept it in there and reinvested any dividends that it put out. So that doesn't mean you put in $1 more. It's just saying you put in 1,000 and then you let it, right? You let it grow. And this is the amazing part, I think, about the global economy, the U.S. economy, how companies operate is, right? This is capitalism in action. And over long periods of time, the system that we have is very, very powerful, and it's a very effective wealth accumulator. So not to say it's always smooth. Certainly there are periods that can be very scary, but that's part of the reason why the returns are what they've been, right? It's not risk-free. And so people are compensated for the risk that they take. And as long as you are in a diversified portfolio and have a long-term time horizon, right? Historically, that's been an extremely effective way to accumulate wealth. And we believe that it will continue to be so.
I think simply stated, it's interest on interest, right? It's
simply put, interest on interest, rinse and repeat many times.
Right. So we do have some live questions, one of which is, for the IRA withdrawal from a joint retirement account, whose age does the IRS use, the older of the couple? And this is actually, it would appear to be a trick question because there's no such thing as a joint retirement account, right? That's what the I in the IRA stands for, is individual. So even though it may be a married couple, each retirement account is going to be in each of their names, correct?
Yes, sorry.
The next question is, if one transfers all their IRA funds to a Roth after age 72 and pays the taxes, if the second spouse passes and all the funds are in a Roth, are there still estate taxes due? And I think this client may be getting confused between income tax and estate tax. So can you kind of explain the difference between the two?
Yeah, sure. That's actually a really good question because people do confuse the two. But think of estate taxes. Imagine you have like 3 silos, right? Income taxes, estate taxes, and gift taxes, right? You could be an asset that where you're paying income tax on it could also be subject to estate tax, right? They're not mutually exclusive. So the fact that you converted to the Roth means that the Roth IRA there wouldn't be income tax on that, right? When money gets pulled out by the beneficiaries. But if your estate level is above the exemption amount, the Roth IRA is still included as part of your estate. And so it could still be subject to, the value of that Roth could still be subject to estate tax. It just wouldn't be subject to income tax. There are stories where people who are above the estate tax exemption on an IRA, they pay like 80 or 90 cents on the dollar because they pay the income tax right at the 40+ cent level, plus they pay 40 cents in estate tax on it. And then on top of that, maybe there's an inheritance tax at the state level. So you can have a situation where almost all the money goes to taxes between income and estate tax if there's not planning done.
Well, we are right at the 12 o'clock time period, so we couldn't have timed this any better than 1 hour. Certainly, if we didn't get to your question, it means it's more specific to you in nature, and we should really answer that offline, kind of in a one-on-one situation, or between us and you and your spouse. But other than that, I mean, I think this has worked out great, where it really gave a chance for a lot of our clients to maybe ask the questions they kind of always forget to ask when they're meeting with us, and for those who aren't clients, right?
Yeah, no, it's been great. Hopefully, so the live Q&A that came in, that's been answered now, Jamie.
Yes.
Okay. Well, thank you everyone for attending. We put, we really appreciate the questions. They were very thoughtful. And we worked hard to try to make it presentable in a format that would make sense. And a lot of work went into it on our part. So, we're happy to follow up. We will send an email with the contact info for the long-term care specialist, as well as the Medicare broker. And if you have follow-up questions, feel free to pass them along our way, and we'll answer them. Thank you.
Thank you.